So welcome everybody to this edition of the Office Hours. So today we're gonna have like the team talking about the taxonomy of decision making within the world of like reward financing, and we've got that Christian and Eric doing a presentation for the folks here, which will be followed by a Q&A session on the presentation and on anything else that that people actually have questions for today. So I'll get this started.
Okay, so so what we want to talk about today is the taxonomy of decision making for real world assets. You can go to the next slide, Will. So what are we kind of talking about when we think about real world assets? Basically, what are those decisions that you find in a real world asset that you probably don't find in crypto? You know, when you're depositing your wrapped Bitcoin or your ETH or what have you in a Maker vault, the Maker vault just does all the work. There's, you know, your decision is to remove it, you know, before it gets liquidated, if that's the case, or just to sit on it. I mean, it doesn't really involve a lot. You know, for better or worse, the real world involves the real world. And, you know, over centuries of practice, there's lots of things that lenders worry about, and there's lots of decisions that get made, sometimes on a day-to-day basis, sometimes rarely, sometimes never. And this is just a small sample of the types of things, depending on the structure, depending on the asset, depending on a whole bunch of other things, issues that will come up in the life cycle of a loan, whether that's a 3-month loan, which probably have fewer, a 5-year loan, which will have more, or a 20-year loan, which, you know, they have all sorts of issues. So just to recognize that real world assets are going to be very different than crypto. So next slide, Will. So back there. So, you know, how do we look at it? And I think what we try to say is, okay, you know, you've got the agreements. The agreements provide for a whole bunch of decisions, provide for a whole bunch of events that happen in the life cycle of a loan. How do we allocate? Who makes those decisions? So what we've kind of said as well, there's those decisions that are really kind of sacred. So what we've called sacred rights, and those, and we'll get to what those are. You know, those are things that really should go to the maker community. And then there's everything else. And then the question is, who does everything else? So next slide. So sacred rights. Now, again, these are here for discussion. You know, we chose these sacred rights as being ones that you typically actually see in the real world, particularly if you have like a bond financing where you have multiples of holders of a debt. You know, if Maker was the only holder of a particular debt, the list might be slightly longer. But, you know, these are the, and second is, you know, these are the types of things that, you know, are maybe most akin to crypto, right? So there's an increase or decrease of the debt ceiling, a reduction of the stability fee interest rate, maybe an extension of the maturity date, acceleration of the loan liquidation. You know, if you think about a crypto asset and you think about what Maker does, when does the community actually get involved? The community actually basically gets involved when the asset's onboarded, and then it's kind of like, you know, you sit and forget. Right? And the smart contract does the rest of the work. So we've tried to approach it saying, okay, you know, in the real world, if you took that DeFi construct and applied it, you know, what are those things that are just kind of the most sacred that kind of affect the underlying economics? So that was this. And then, of course, you know, to the extent that the Maker token holders decide they want to decide anything, that's entirely within their discretion. So next slide. So what about everything else? Then the question is, who's delegated that decision-making authority and what decisions? So there's a couple of ways to approach it. One is you could have the borrower directly making all the decisions for the lender, which doesn't seem quite sensible. Or you could have the borrower indirectly, basically the borrower telling, the trust sponsor or the trustee to do X, Y, and Z. Well, it's the same as the borrower doing it. That doesn't feel as comfortable either. Or you could have a third party accountable to maker directly or indirectly. So that third party could be directly accountable to maker. Maker is, for instance, a beneficiary of a trust. Maker could specifically instruct that third party to take an action. And you kind of see that, for instance, in the success case where you have the concept of a verification agent looking to maker with respect to particular issues. I would call that kind of a direct third party being accountable directly to maker. You could also have, a committee of maker delegated representatives. They're people that kind of represent maker in the real world that could make a number of decisions. But again, who's making it? And more importantly, then what are the decisions that are being made? So next slide. So again, third party accountable to maker directly or indirectly. What are some potentials? These are not the only ways you could do it. Well, you could have an independent third party. The independent third party has the advantage of being independent. The independent third party may have some disadvantage in that they don't really know the commercial deal. I mean, if you're hiring a director in the Cayman Islands to make directions and make determinations, does that, third party director in the Cayman Islands who's, sitting at their beach house, nice office, sipping, pina colada, actually really know what the deal is about? Are they living the deal? Do they understand all the nuances of the transaction? Probably not. You could have a committee of delegated maker representatives. The advantage that they would have is they're going to have some familiarity with the deal, because that in effect will be what they've been tasked to do. And they will have, because maker doesn't exist, they won't necessarily have a fiduciary duty to maker, but there's going to be a reputational responsibility that they have to maker. The downside of it is they're associated with maker, and there's lots of talk about lots of use of the term private entanglements, and I think that's probably what this is getting at. An entanglement whereby a committee actually is associated with maker. I mean, the committee representative shouldn't have any stake in the deal. That would be ridiculous. So, a financial entanglement doesn't make any sense. But maybe it's just that association with maker. And you'll recall I've been going on for some time about the trying to balance centralization and decentralization. And this association with maker may lead to kind of slide things a little more to the centralization side of things. Or you could have a combination of both, and that may have its advantages. So next slide. So if you did a committee of maker delegated representatives, what could that look like? The first thing that I would say is that this is not set in stone. Every deal can be different. We can iterate. We can learn from our lessons. Improve. And maybe it's a bad idea and we come up with something different. Maybe technology changes and we come up with a better idea. But this is what we've got in the meantime until somebody, it's what my small brain has been able to come up with. Have delegated members approved. Make sure that the delegated members are approved and replaced by maker token holders from time to time. You could set their seat, if you will, their appointment 6 months. They get rotated in and off. You could make it a year. You could make it daily. Something that those delegated members don't necessarily get too intimate with the transaction and are really held accountable to the maker token holders. The delegated committee could monitor independent third-party actions. The lender, the borrower report to maker. Maybe this committee and the committee members can verify or approve third-party actions, data, et cetera. Maybe, and with respect to some decisions, they could be, because they probably know the deal better than anybody, they could instruct that independent third party within a defined set of actions. So, if there's certain things that have been agreed that this delegated committee can make, decisions that the delegated committee can make, they can instruct the third party to take those decisions. And then there's a question as well, how does this delegated committee actually decide? Is it unanimity? Is it majority? My view is probably majority. You could have an independent third party, paid third party sitting on that committee. But that's okay. It's just an additional cost in the process, but that would provide a degree of independence, maybe, or an alternative voice. So that's kind of the types of things that we are thinking about in terms of a committee of delegated representatives. Next slide. So I am now going to pass it off to Eric.
Thank you. Make sure I have my video on now that I'm done eating lunch. Here we go. So let's talk a bit about lender decisioning in the real world. What's out there, how are things done, what might we learn or not learn. So first I want to talk about, a couple different ways, a couple different lending structures. First, you have a simple bilateral loan, like a bank makes a loan to a company. Let's talk about how they make decisions in that framework. Then let's look at a public bond securitization, which is a much more complex entity and an interesting one because decisioning is more decentralized in a sense. And let's think what's helpful in that potentially to DeFi and Maker and what isn't. Then let's talk about how might we do it. Here's a rough proposal, and then let's talk about it. What the delegated committee kind of what do you need in a delegated committee? I mean, this is not the ironclad answer of all answers. I think there's some good principles here. So next slide, please. So lender decisioning in the real world. How's it done, or what do people think about? Well, first you think about what's the loan structure. There's a variety of loan structures. And then you start to think about how important is the decision? What's the impact potentially on the chance of the lender getting paid back in full or not? I mean, we'll talk about it a lot of different ways, but at the end of the day, I think the lender really cares about decisions that impact the chances of them getting paid back. Everything else is kind of nice to have. That's the North Star. And then who can make, decisions, for around lending? The lender can make a decision if it's a loan, the bondholder, but here, as we'll talk in the securitization, the bondholder is typically a diversified set of institutions. So it's not one bondholder. You're going to have a vote across a diverse group, or you could have some type of third-party agents, or you could have some mix across, these different ones. And then I've also put a graph here to think about decisions. I've split them into 3 levels: high, medium, and low. For a reason. But we'll get to that. It doesn't have to be 3 levels. And then also one of the key questions is going to be if it is 3 levels, where do you draw the lines? What's high impact? What's medium? What's low? All right. Next slide, please. So what about a simple loan? The lender makes a loan to the borrower. This is about as simple as it gets. I will call it a bilateral agreement, a fancy word of saying 2 parties, a borrower and a lender. Who does all the operational work around the loan? Making sure, the funds are available, just whatever needs to be done. The lender does it. Who does all of the decisioning? If things have to be decided on, the lender does it. So you can see they do it across high impact, medium impact, and low impact. It's all the lender typically. They're in control. This is a fairly, simple way of doing things. And next slide, please. It works well in some areas and not as well in others. So next slide. Yeah, thanks. What's the strengths of doing it with a simple loan? The lender has a lot of control and a lot of information access. That can be very important. You want to get paid back, control matters. The lender can also be flexible and timely. If the borrower has a lot of needs to change terms, the lender typically can respond quickly and flexibly. There's usually a price for it. And it's also typically viewed as an ideal structure for weaker borrowers, that need more oversight, quite frankly. You're not as comfortable saying, hey, here's $10 million, send us a report every month and pay us back in 5 years. that's something that has to be earned. The weaker borrowers, typically have a lot more oversight, and will also have, maybe if they're fast growing, more needs to change the loan terms, as their business adapts. From a DeFi perspective, and again, I'm thinking of strengths and weaknesses from a DeFi perspective. There's clearly other ones, from the real world perspectives. I've consciously left those alone. So this is really not decentralized. If I had to pick, the one main criticism of lender model, there's a single point of failure, i.e. the lender, and it's not transparent. It's essentially, it's the lender to the borrower, and no one else knows what's going on. So this has some strengths, and it definitely has some weaknesses too. And I will say, if folks have questions, please feel free to ask as we go. I don't have to wait to the end. I'm happy to engage as we go. It'll probably make for a more interesting presentation. Okay, any questions? All right, let me keep going then. So next slide, please. All right, let's look at a public bond securitization. This is not a simple loan. Think about this. Say it's a $500 million mortgage deal. It's going to be held by maybe 20, 30 different institutions. Think of like PIMCO, BlackRock, Fidelity, big insurance companies like Mass Mutual, New York Life, pension funds. There's a whole bunch of sophisticated institutional investors are going to own different, each one's going to own a meaningful amount, probably at least 10 million, but no one typically would hold, anywhere near a majority. So you can already think about governance. This is going to be tricky because it's a broadly diffuse group of owners. How's it structured? This is where it gets very complex. There's going to be a bankruptcy remote SPV, or special purpose vehicle like a trust, and then the assets go into the trust, and then the bonds are issued against the trust, and there's a governance mechanism, i.e. it's complex. How are the operations done? Like just the lending day-to-day activities. It's typically through qualified or trusted third-party agents. You're going to have folks like the trustee, of course. You could have a collateral agent. You could payment agent. There's a whole bunch of different third parties that can serve different roles. But in a sense, since this is a bankruptcy remote SPV structure, it's owned. The trustee's really running it on behalf of the bondholders. So if you think about the $500 million deal, say all the auto loans are put into this, that's your assets, a whole big pile of auto loans, and then the bondholders have to get paid back from those. So they want this run in their interest, where every penny of those auto loans, is backing what they're doing, and that's how they get paid back. And then it's usually simplified and decentralized enough that the third-party agents do most of the day-to-day, work. In terms of higher level decisioning, if there's typically, other than a few specific things, if there's a material issue so it matters, you often have to get a vote of the bondholders, and typically 2/3, a supermajority. So guess what? When you have 20 or 30 different bondholders, very little gets done. It's hard to get a hold of them. It's hard to get them engaged. If the deal starts getting in real trouble, that's when people will pay attention, and then you can get some stuff done around distress and liquidation. But kind of normal course of business, you're just not going to get the focus on it. So what this also means is that the structure, it's kind of like tied up in a box, and then it's sent on its way, and you're not going to change the key terms. You're not going to change the interest rate. You're not going to change the maturity date. It's just it's a close it up, lock it up, and let it go. It's a good structure, but let's talk a bit more about, if we could turn the page. Let's talk about its strengths and weaknesses from the DeFi world. So one, I'd say it's quasi-decentralized. Again, think about how it's managed. The highest impact decisions are done by the bondholders. They vote, similar to maker holders. And then kind of the medium, or probably almost all more low impact, anything not particularly material is done by third-party agents that have been delegated into very specific roles. So the trustee is going to have a trust indenture, that specifies exactly what they do. If there's a payment agent, that's specified. Any third party doing something is going to have a very specific legal agreement, that tells you exactly what they're doing and what they're not doing. And these roles, Sorry.
And Eric, I would add to that, to the extent that it is not stated, the trustee or the third party is not going to do it.
Yeah.
I mean, it just, if it's not in there, if it doesn't say trustee shall do X, Y, and Z, trustee's not going to do it because they're going to say, well, you've paid me X to do the things that I've agreed to do. And now you're asking me to take an action to which I don't have an indemnity and I don't actually know, whether I'm supposed to. So, hey, guess what? I'm going to go back to you and say, hey, bondholders, please, you want me to do X, Y, and Z, but you haven't told me to do that in the past. It's not in the agreement. So please provide me an indemnity.
Exactly. And I would say, even to highlight that point, if you read a trustee agreement, lots of fun reading, but they typically have a term that says the trustee is not required to do anything that requires them to put their own funds or take on any risk or liability, unless it's been unless someone underwrites their liability. So this is like one of their defining principles. Anytime they have to assume pay their own money or take liability, they expressly don't have to do it. Right? It's just not their business model, And so, but let me go back to this again. So it is quasi-decentralized. Most of the day-to-day stuff is done by the third-party agents, though it tends to be fairly easy, routine stuff. It's not material. The key decisions are made by the bondholder votes, which generally doesn't happen because it's hard to get. It is transparent. And the other thing I should have said here, I'd say there's a level of almost anti-fragility where you can replace the different key parties. If you don't like the servicer, you get a new servicer. If you don't like the trustee, you can replace the trustee. Though I will say that takes a bondholder vote, so that's not easy, right? So in theory, there's a lot of ability to adapt and make it anti-fragile. In reality, it's very hard to get those votes. So I would say that's a bit more qualified. What about weaknesses? When we think of this, what do we like? What don't we like? The lender lacks a control in kind of high quality information. They get information, but it's slower. And it's not like a private loan where the bank can say, I want this, and it's all over the situation. Here, if you're an owner of bonds, you got 28 other co-owners and you have to vote on something. You have a lot less control. And it's fairly inflexible, as I've noted. It takes these votes to get things done. So things don't get done, right? And it doesn't do well, for difficult assets that require, adjustments. This thing does not adjust well at all. You put it together in a box, send it down the middle of the fairway, and it better stay in the middle of the fairway because it doesn't have a lot of ability to steer or to redirect, right? Once it's off course, it's going to have a hard time redirecting. It is ideal for well-established borrowers whose asset performance is well understood. You know exactly what you're getting. If it's $1 billion Ford Motor Credit deal, what, Ford's been doing auto loans for 50 years. You know what the performance is going to look like. The chances of this thing needing key votes for Ford Motor Credit is very small. That's an ideal thing to do. For small unknown lenders, startup lender or borrowers and stuff, it's very, very poorly designed for that. Okay, and so again, but keep in mind, as I said, the high impact votes are the bondholders, and then on the graph you can notice the third party agents tend to do everything else. I will say medium impact basically isn't going to get done. I should have said it doesn't get done because the bondholders don't care enough about it, but it's material, so they would have to make the change, and they're not going to get organized to do it. Okay. Next slide, please. So lender decisioning, what about for maker RWA type deals? What can we learn? How do we think about this? This is, we've gone through some real world examples. What's our takeaway? Well, first I'd say, what are our principles for maker RWA deals? I think we want and how they're managed. You want transparency. This is DeFi. You want as much trustlessness as you can get. You don't want key, what's the word? Key man or centralization type risk. And you want it to be efficient, or at least relatively efficient. You need this to work. We could have a great decentralized mechanism that doesn't work. It does everything else we want, but we lose money. Not a great strategy. So from my perspective, and I'd be interested to hear folks' views, if you have something that's really good transparency and trustless, to me, I think that's relatively decentralized. because you built in anti-fragility, or at least I think to make it trustless. I'd be interested in other commentary. So we went through the bilateral loan already, which gives you a lot of control, flexibility, and timely decisioning. That's helpful, but it's very centralized. That model, so clearly works for the first reasons, but we don't like the centralization. Then we went through the securitization, which has this quasi decentralized nature to it, where the bondholders vote on key decisions, and then all the other stuff is done by third-party agents, and it's transparent. But we also noted it's pretty inflexible. There's not a lot of oversight, and quite frankly, anything that incredibly important decisions just won't get voted on, right? It's inflexible. Next slide, please. Okay, so how might we do something at RWA? For what it's worth, I've split decisions into 3 levels. Christian's already kind of, I think, hinted at this, but let me tell you what our thoughts are. This is, it's a working proposal. 1, high impact stuff, very important, very material. Makers should vote on it. The MKR holders should vote. This is the essence of the high level governance. And it's going to be, major changes in the management of assets, as Christian said, around the payment of principal and interest, around the timing of the payment of principal and interest, around liquidation of assets or something like that. Big things go straight to them. Keeping in mind, these are not quick and easy votes. If the maker voters were 3 guys who got together, 4 times a week, you would probably say give them a whole lot more decisions, but it's a fairly diffuse community, and they're not, kind of structured finance bond experts. So not only does it take time to get them to vote, you're probably going to need to have a robust discussion in the forum, to see the pros and cons of a given vote. It's just the way we're constructed. It's not like we have the top 5 guys at PIMCO's bond unit. If that was our delegates, you'd probably give them most decisions. And so it's going to be around big things on asset, and also major changes in the program, in the governance. So if you want to say, hey, right now, only these big votes, or these key big votes, go to maker token holders. What if we want to take those votes away and give them to the delegated committee? You're changing the game of how things are done. That's something you're going to want the maker voters to weigh in on, because you're essentially impacting their decisioning. So I think they should have a say on whether you're allowed to reduce what they can decide. Then medium impact decisions. What are these going to be? And we'll talk about what on the next page more about who will be in a delegated committee potentially. Default administration. If things start going sideways, how you're going to work out of it. The maker token holders are going to ultimately have to make some decisions. If there's a workout and they're going to take a haircut and lose money, they would have to approve it. But there's a whole lot of kind of in the weeds administration. Who do you hire as your workout committee? To work with the troubled borrower. To come to a proposal is what might work for them. So it's just a lot of oversight of executing on what the maker voters have already opined on or voted on it at a high level, and also amendments. But here's where it gives more flexibility. The securitization doesn't have this, but what if the borrower says, hey, I'm doing really well in the US lending. I've already been testing the Canadian market for 8 or 10 months, and I'd like to start borrowing or doing business there. And our agreement with them doesn't have that allowed. Someone needs to sit there and think about it, and make a decision. I would argue at some point, if it becomes a big enough change, you probably go to the maker voters themselves. But, if they're like, look, let's allow us 10% of the whole facility to be in high quality Canadian loans. It's not that big a deal. Someone, should make the decision efficiently and probably not, in a sense, waste the maker voters' time.
And to give you one example on medium impact decisions, it's a very US centric example. Well, let's say a borrower goes into bankruptcy, right? It wouldn't be the first time in the world that a borrower files for Chapter 11 bankruptcy. In the US, that means basically a workout. So it's not insolvency and we're going to liquidate all of the assets. It basically means the creditors are stayed from taking any action. People are going to be receiving notices all the time from the bankruptcy court. They're going to have to be monitoring what's happening in the bankruptcy court. There's going to be times that they have to respond to things in a timely manner in the bankruptcy court. How do you go about doing that when you need to be proactive and responsive within timeframes that are not set by maker governance, but are set by a federal court sitting in New York? And if you miss that window, you snooze, you lose.
It's true. Yep. And then around the low impact decisions, these are typically delegated to the third party agents. What are they? To review and approve funding requests if it's a revolving facility, processing payments, a key one, but very kind of a standard routine, and they do it just to the contract. Providing asset portfolio and borrower reporting, letting you know how your assets are doing, ensuring that the collateral is indeed perfected, that your liens are there, that you have a good claim. None of these are particularly sexy, but they're important, but they can be very well specified in contracts, and there's very good third parties out there to do them. So I think they're and in an ideal world, I think in DeFi, you want to give as much to the third party agents as you can, but you don't want to give them stuff they're not really equipped to do. At the end of the day, it's almost like, how do I want to put this? It's almost like having kids. Your babysitters take care of your kids and do a reasonable job, but the parents love them in a different way. When it comes to lenders and their assets, you want this really kind of engaged oversight, or you tend to get worse results than otherwise, has been the historical experience. So if I could, next slide, please. Let's talk a bit about the delegated committee, goals, or what should it do? I'm not being too specific on exactly who should be there. I think it's more trying to think about what is a need on the committee to make good decisions. You're going to need structured finance expertise, clearly. If you could get some really smart guys, but if they don't know about credit investing and structures, they're probably not going to be that good at knowing what to do. So you got to have some expertise there. You want someone who already knows the deal, because if you have a lot of smart guys, even with structured finance, and they don't know the deal, they're going to spend the first couple of days reading through all the docs and reports and talking to the borrower, trying to understand what's going on. You'd rather have the information or probably learned at origination some way contained in that committee. It'll get you to speed quicker. You want to be able to make timely decisions. If we want to really slow longer term decision, we can go to the maker token holders. And this one, number 4, is a big one. You want to be aligned with maker. At the end of the day, you want people that are there to maximize value to maker. They zealously guard maker's interests. This is one of the reasons, for instance, I would not suggest you let the borrower create and manage too much of this, or you wind up with the fox designing how to guard the hen house. Typically not a great strategy. So you got to get folks that really put maker first and foremost. And then finally, in terms of decentralization, you want to minimize a single point of failure. So think about how people could be a little too entangled or conflicted. I think by having a committee and having some rotation, there's probably a lot of ways to do that. But you definitely want this to work well. Oh, and sorry, one last thing I didn't say. The committee should probably have a high level of transparency, needless to say. That's an important one. So everything they're doing, should be able to, show the community and the maker holders what they're doing and why. So there can be full discussions as needed, across strategies and actions or inactions. So that's pretty much what I wanted to say. I said this is somewhat a work in progress, but we're going to have to get this over the line pretty quick. Like deals like HVB, we have to work out exactly what to, how to make those decisions. Given that we have a quality bank, that helps, but maker still has a level of decisioning, that's going to need to be made at times, or at least to be structured. So if we wind up in some bad states of the world, there is a decision process, even though we probably will never go there.
And I would add that part of what I think we'll do, sorry for the sirens, what we'll try to do is in our various risk assessments, actually come up with a proposal based on the underlying asset, the underlying borrower, for the community to vote on. My concern about being prescriptive as saying, okay, well, this is the approach that we're going to take for every asset, is it may not work for every asset.
Yeah.
And we may not be learning. And, frankly, we're the ones struggling with this issue on a daily basis and trying to understand how things are work. So, being able to be iterative and learn and come up with new proposals and just come back to the community like we are and say, okay, well, this is what we did in the last deal. It worked or it didn't work. I think gives us really a chance to learn and to experiment based on, some prior precedent. Kianga asked whether we will need to separately compensate for these committee roles. I think if you're going to have a third party, independent, not maker related third party, yes, you're going to have to. Now, you could come up with I've thrown this out before and some people like it and some people don't. So I'll throw it out again simply because I know it's not widely accepted. You could have a committee, for instance, somebody from real world finance, they know the underlying deals. Maybe you have a legal person there. Maybe you have somebody from SES just as they know the maker system. Maybe you have a delegate or a different delegate or two delegates, to give maker token holders some visibility. I don't know what the answer is. I mean, we're designing this for maker for the first time.
Christian, I think if I was going to do it, it's not my call, but I could see where you have the internal expertise. How might you do it? You could have perhaps a few delegates on the committee, and this could rotate over time, who are more interested and knowledgeable in this area. And you probably have a few folks, with the specific expertise, from RWF and legal and maybe oversight, and I would think between those folks, you would have more than enough knowledge and ability, and you have to think of the right decisioning. I mean, you want a unanimous decision? Is it purely the delegates? But I definitely think you have enough knowledge in house. If folks want to get more external oversight, you can certainly do it. But yeah, you're going to pay for it. I mean, I think because let me make a few points. If you start saying, hey, let's get all these external oversights to make all these decisions, which is certainly fine. At some point, you're like, you should get an external bond manager and let them do everything for you. Because at some point, that's really what you're starting to do. So and then the other point is that if you're really worried about too much entanglement and lack of DeFi in lending decisioning, I would also say we probably shouldn't be doing private credit, period, because most of those same issues, honestly, are up in the initial decisioning too, when maker decides to invest or not, at least from my perspective. This is just like another form of the initial investment decision. You're just kind of revisiting and saying, okay, this thing's evolved a bit. What do we do next? Yeah, so that's my view.
So like I said, I think it can be iterative, welcome suggestions, feedback. Colin has suggested that maybe somebody from another protocol, if somebody's willing to take that role on, there may be a cost to us. For instance, one of the costs that we haven't talked about is, either indemnification or insurance. Right? Because what's going to happen, and frankly, me sitting where I'm sitting, doing what I'm doing, I keep worrying every once in a while whether one of the borrowers is going to sue me because they're upset at something that I've put in the form, right? And I don't have any insurance from maker. I don't have any indemnification from maker. And, if you're a third party coming on, acting for and on behalf of maker, I would certainly ask for insurance.
You start sounding like a director role.
Yeah, and maybe maker has to have a reserve for indemnification. I mean, people's reputations are on the line, right? And when things go bad, things tend to go bad quickly, and there may not necessarily be full alignment between the borrower and the delegated committee. So it's just it's an issue.
And there is actually a discussion around that has been on the back burner for a significant amount of time. So layer 0 had actually proposed at some point to have like I guess like a common pool insurance fund or so that actually contribute this. And it's actually, that's not only for people like us that actually are more like on the credit and legal side, but it's also like even for developers, because at the end of the day, who commits the spell at the end of the day for those decisions are also to a certain extent engaged in the whole process, right? So I think this is there is this pool of insurance for across the DAO, but it's just that is being taking quite a bit of time, I think, to realize it. It's been around for, I would say, about 6 months or so, that discussion, and probably would be probably beneficial at some point to bring even Leia in one of these calls and have a talk to us about that.
Great.
And Kianga in the chat pointed out a lawsuit being filed against the governance members of governance of Blockworks by a law firm. Just remember, my response was damn lawyers, but remember, lawyers are pretty creative. I'm sure they're working on a contingency. So anyway, that's kind of, that's where we are. Like I said, we have 3 minutes left. We don't have an answer. We want people's inputs. We are, I think, with SocGen, we're probably going to be on the very light side of governance simply because of what the asset is, who the counterparty is. We've got Dees Group acting as kind of our agent. There's really, because they're covered bonds, there's actually nothing that SocGen can do anyway. It's pretty well regulated by the EU, so we just kind of piggyback on that. Yeah. I think Alan on the various Monetalis proposals has really been thoughtful in working with me trying to think about governance. And I'd actually asked, and Alan has commented on these slides in an earlier paper that I wrote that was just trying to kind of get our heads around, how we wanted to approach this. So I think Alan has really been a thought leader in trying to kind of address this issue. I think, if you look at the Monetalis proposals, they have the concept of an attester. I think there is the concept of a delegated committee. I think even if you look at the success MIP, whatever number it is, MET's kind of got some level of a delegated committee with perhaps a somewhat smaller set of decisions to be made. But it's clear within the broader community that this is an issue that needs to be addressed. I think, and if you look at the MIP 6 that was greenlit for HVB, it's very clear that there's contemplated a delegated committee in the MIP 6 application, because we just need it. I mean, there needs to be some governance mechanism. And so like I said, I think it's going to be an iterative process. We learn as we go, and maybe somebody will come up with a great idea that makes it better. And I think we're open to it, but I don't think that we can deny that it's an issue that we need to be aware of and address, because I think it may be one of the most important decisions, and one, frankly, that we've been struggling with. Eric and I particularly have been struggling with since January. This presentation is probably 4 months late, simply because we couldn't get our heads around how we wanted to do it. And we've been debating it for several months.
I think the other thing I would stress is, at least as we work on what some decentralization ideas in the real world that can work, it's easier to decentralize when you have borrowers that are relatively well established with good assets that you don't need a lot of attention. Typically, the more attention the borrower and their assets take, the more and more internal work there is, and it kind of pushes you more towards centralization. And that's not a bad thing. I mean, a lot of lenders make great money in this, but if you really want to try to stay decentralized, I would definitely recommend that we work with relatively well-established situations just to minimize the touch, because the more touches you get, the harder it is, I think, to stay decentralized in some shape or form.
Yeah, great. Any questions? Any other questions on the chat or raised hands? I don't see any raised hands. So if not, we will be posting, I think, a couple of the slides that Eric had, maybe with a little bit of a narrative in the form, just to give a little bit of context. And then we will schedule some time with SES to do a broader presentation, just in case somebody wasn't able to attend office hours.
This is an exciting topic. Everyone deserves to hear it.
Yeah, I'll be.
I need more time on YouTube too. SES.
It actually is very exciting. It's very exciting to see. Nice work.
Yeah, I'll be.
I think it's important. I don't know if I'd say it's exciting.
It's critically important, which is exciting.
Okay.
I'll be posting as well the video on our YouTube channel, so other folks actually can look and look at it.
Sounds good. Thank you, folks.
Thanks, everybody.